Hello, this is Heather Marchant from RP Capital, and I am going to walk through a Proforma with you. So here at the top, you will see the property's address, and then we have adjusted our Proforma recently to add fixed and variable expense headings. So here you will see the income analysis with the purchase price first. This is the most common box that people look at here. So then you have the 30-year fixed mortgage. This is 25% down or 75% loan to value. And the interest rate on this particular property is a lot lower than the typical rates that are happening right now because the seller is paying 2% closing costs toward buying down the rate with the lender. So you'll see here that the mortgage payment every month will be $1,177 for this property given these loan terms. Then you have property taxes. We will, on new construction, call the county and look at their actual property taxes of what we think it will be. We obviously don't know what the assessed value will be. This is new construction, so we try to estimate high. On rehab properties, we will usually pull tax records as well. Forecast sometimes if we believe that the taxes will go up with the raise in the purchase price from the rehabber purchasing and then fixing it up and selling it. As far as the HOA fees, there will be none if there is no HOA set up. Property management, that is a percentage of the rent range. It is calculated off of the high end of the rent range as well. And then here you have your insurance cost. Our insurance costs in our Proformas are actually calculated using our master insurance policy. So those will be pretty accurate. You should receive a quote that it should be almost to the penny of what is in the Proforma for that insurance cost. In this particular case, it is because there is some lawn care expense on this property that is not covered in the HOA. So we actually pulled a quote of what that would cost, and that's usually when you see there are a couple of additional expenses that are with this particular property that are not covered under these other expense items. So if we know it's a regular monthly expense. The rent range, this means the property is not leased yet. If the numbers are identical, it means the property is currently leased. And the cash flow range as well, because of that low and high end of the rent range, will differ. Then here is your basically your percentages that people are going to look at to analyze the property compared to other properties. So this is your cash on cash return or return on investment that is calculated based on your down payment, which is why this cash word is here. You'll see based on down payment, we added to our Proforma because this was confusing to clients. So this is this number here annualized, so $12,858. We take this number and we divide it by the down payment, and that is your cash on cash return. So another way of looking at that is you're getting 15% of your money back every year with this property. Principal reduction, this is the tenant paying down the mortgage. So they are paying you rent and then you turn and pay the mortgage. So that is how this return is calculated based off of an amortization schedule. So we take this number here, again, divide by the down payment. So that is the percentage of rate of return. Then you have tax reduction. This is depreciation, a 27.5-year schedule. So a standard depreciation schedule. This is not with any additional accelerated depreciation such as cost segregation. This is just straight line depreciation, and it is based on a 25% tax bracket. So this will differ depending on your financial situation and how much, what percentage tax bracket you are in. But this is an estimate, and it is there calculated as a rate of return. Then appreciation. The rate used is 3% for this. This number of 12% is because you have financed a portion of this property. So we take that 3% appreciation and then we divide it by the down payment. So the whole property appreciates, obviously, not just your down payment. So that's why this rate of return is higher than the 3% that we're using as a calculator. So the total rate of return here on the purchase on this property will obviously, you'll have to sell the property or refinance to be able to take advantage of a few of these, right? So your principal reduction is money that's locked up in the property as well as the appreciation. However, they are real rates of return. The cap rate is the annual cash flow divided by the purchase price. So these numbers here will change together So over here, you'll see property details, any incentives the seller is offering. We keep it brief, so sometimes I'll have more additional details to tell you, but like the 2% closing costs aren't in here, although it is included up here to buy down the rate. Then you have the type of property, square footage, etc. on the right-hand side. So this section here at the bottom is used as a projection out over 30 years. This is where we're kind of looking at adding in variable expenses and using some assumptions. So these assumptions are what we are using down below. I'll go through those really quickly. Appreciation rate I covered already. Vacancy loss, so 4% of your rent we will calculate every year as an estimate for vacancy. Income growth, this is increasing your rent on the tenant every year, raising rent. So all these assumptions can be changed fairly easily by us. So if you want to make changes, let us know. Closing costs, this is actually for when you go to sell the property. This is often confused as closing costs for the purchase. It is not. It is analyzing the sale down below. And then maintenance, so any other expenses to maintain the property, 5% of gross rent. So here you'll see we have added vacancy and maintenance. Everything else is identical. The expenses from up above are brought down here, as well as the mortgage payments from up above are brought down here. So the only difference between the top and the bottom is this vacancy and maintenance number. Brings down the cash flow, obviously, the annual cash flow by about that $3,000 mark as compared to above. And then these are going to go through the tenant paying down the mortgage. You'll see that number increasing every year according to a 30-year amortization schedule. The loan balance changing as the loan is paid, and then the market value increasing by that 3% appreciation. And so you'll see that your rate of return increases because of those assumptions here. And then down below, this is for when you go to sell the property. So we like to be realistic that you don't just get to sell and take all the profit that you have made on the property. You do have costs to sell, which is what this closing cost number is, and it will go up every year because the property is going up in value. Then you will have the cumulative cash flow over time, and your initial cash invested does not change because it was the down payment, and your net profit numbers. So this is extremely speculative, obviously. The property could perform better than this. It could perform worse than this. We're taking industry averages in order to calculate. So I went into a little bit more detail than I normally do, but I wanted to be a little more thorough where clients have questions about how to read this. Let me know if you have more questions. You're welcome to reach out.